live streaming to talk about the current market situation of Korea. Crazy market is going on, and then it's an exciting time for a researcher in behavioral finance, especially living in Korea. Okay, but let's see. And I'm trying to check my own screen through my channel somehow, but I don't know. Let's see if I can check out my live streaming through my video over here. That's good. So I can monitor myself somehow. Good. Okay. Is it all right? Okay, the angle is important, right? Angle. Okay. Okay. Good. So, welcome to my channel, and I opened my chatting window so you can ask me questions. But here is the thing: Korean stock market crash and bubble and crazy situation. Why is the question? I got this question from a journalist from China, and the name is Chupeng, and working for National Business Daily, 每日经济新闻, I guess. 你好, 您好, 认识您很高兴. And I understand my Korean audience may not understand this. I will speak in Korean and then live cast it maybe tomorrow in Korean, but today it's going to be in English. And for that part, I guess my students, former students, living in Singapore or Hong Kong or international spots, they may access it and enjoy my talk a little bit, okay? I don't know if this is accessible from China, but let me try. Okay, so Korean stock market crash, why? And I received very important questions, 5 questions from Chupeng Yue. Thank you for giving me such an insightful questions, and I'll try my best to answer these important questions. It helps us understand the market bubble and crash and psychology. And to give you a brief understanding about big picture about what's happening in South Korea, here I give you a stock index performance of 29 different countries over the past 12 months. So 1 year, so since last July until this July, until yesterday, not today. And you see 29 different countries, but I give you 30 indices. Okay, I have 2 different indices of Korea, equal weighted and value weighted. Value weighted index, orange color, has been going up crazy. Starting from 100, it reached 250 level. Okay, 150% gain within a year. Okay, that was outperforming all of the other markets. Okay, by far. You see US, China, Japan, and then Asia or Europe, Turkey, you name it. If you look at it, right, South Korean market seemed to have outperformed really crazily good, okay? But another interesting point is that if you look at the equal weighted index of Korean stocks, it was not that much performing good. In fact, this is yellow dots over here. It is kind of hidden in the middle, but it was underperforming the average, okay? So I will get back to that issue a little later. Why equal weighted index was underperforming the rest of the countries, but the value weighted index was super duper outperforming the other countries. Also, why was the movement such bumpy like this, right? Crazy up, crazy down, seem to have been going on. And that's what we've been experiencing during this first half of this year. And here comes the question from the National Business Daily. First question is, why did South Korean retail investors continue to increase leverage when the market was already near record highs? Number two question is, why did many investors continue buying as stock prices fell rather than reducing their positions? Third question is, how can buying the dip with borrowed money turn into margin calls and forced selling? And there came a very relevant case today, a very exciting thing I want to share. Number four question is, how do fear, herd behavior, and loss aversion make a market sell-off more severe? Okay, social behavior, herding, and then exciting concepts will be discussed over there. Last question is, could this sell-off be the beginning of a broader financial crisis? So wait for those answers. Now, before I start a more serious discussion, let me give you more big picture so that we can have some having common ground to discuss it together. Until yesterday, July 30th, right? If you look at the valuated index of Korean stock market, it gained like 61% over the last 12 months. Okay, 61%. Whereas if you look at the equal weighted index, it was gaining, it lost actually 11%. Okay, so clearly the largest companies were driving the outperformance. Very small number of them, i.e. semiconductor industry guys, were super duper outperforming, whereas the rest of the companies were really underperforming. That's a problem for the overall economy in South Korea, I believe. Why should it be such bipolar? It is worth questioning this, you know. Now I showed you the picture before. I narrowed it down to a handful of indices, including Shenzhen and then Hang Seng and Shanghai indices, right? Like this. Yellow line is equal weighted Korean index, and then orange line is value weighted Korean index. Now, and if we narrow down to Korean index only, KOSPI plus KOSDAQ, and 26, 25 stocks in KRX overall, this looks like this orange line, value weighted index performance, and then yellow line is equal weighted index, right? And if I concentrate more on the memory chip companies, you know, performance, and then here the picture I show you is the percentage of Samsung Electronics and SK Hynix. I told you there's a huge bipolarization going on in Korea, and the memory chip companies happen to be the country's biggest two companies. Samsung Electronics, by far, it has been the number one company for a long period of time, like 30 years. And the second one is SK Hynix. Maybe today it's switched a little bit or not, I don't know. But these two companies, how much, okay, what percentage do these companies take up in South Korean market? It used to be around 20% in last year, okay, July. But with the upcycle of this memory chip, the portion of these two companies surpassed 50% level this June, okay? At the end of June, it reached 55% level like that. And that is the point, coincidentally, when this SK Hynix, their market cap surpassed Samsung Electronics market cap. And then afterwards, the market was tanking ever since. What a coincidence. And KOSPI cumulative net buy. Who was buying it cumulatively? Who were selling it, the stocks, right? Overall in Korean market. I started to accumulate the net buy volume depending on the kinds of investors. individual investors, institutional investors, and foreign investors. What is nice about Korean data is that we have a classified trading volume data depending on the character of these investors. Individuals like you and me, okay, we are, noise traders. We don't know what is information, what is the signal versus noise. We have no idea. That's individual investors, dumb money. That's yellow line over here. And then institutional investors, they are smart monies like pension funds and then brokerage houses and all these kind of guys. Especially, individual investors have been buying even more over the recent month over here like this. You may question, why were foreigners selling off? Were they running off, okay, or running away from Korean market so that the financial crisis will happen and then it's a disaster time, like in 1997? And my answer is no, okay? Remember, this is just the absolute dollar amount or billion Korean won amount, which doesn't tell you about how much these institutions or foreigners hold in their position. If you think about, the chances are, and it turns out many people answered it, that foreigners were selling off over this period because their position, okay, in Korean market was surpassing their limit. Because the Korean market cap was like increasing like crazy, foreign investors like BlackRock, they had to reallocate their portfolio, okay? Because Korean market is, the emerging market. The emerging market, well, you cannot allocate more than certain percentage of your total asset. In contrast, Korean market was performing like crazily high, so that your portfolio holding was expanding like crazy, so you had to sell off certain amount like that. Okay, that's the nice explanation about this trend over here. In contrast, Koreans individual investors were, really crazily buying. And the question is about this part. Why do they buy? And moreover, this is the period when the stock market was crashing. Why do you buy more? Okay, isn't it crazy? And I have some explanation about it. 4 big points of investor psychology. This is going to be my skeleton of argument. Over extrapolation, overconfidence, disposition effect, and social transmission bias. Please remember these 4 parts, right? These are really, really hard, the important concepts in behavioral finance. So one after another, I'm going to go through this one, okay? And my answers will be formed based on this one. Now, the first question, why did South Korean retail investors continue to increase leverage when the market was already near record highs, right? Well, to set the tone, right? Get to the shoes of the Korean retail investors, right? I want to give you a picture about the real estate market, because historically, over the past 70 years or more, housing market, real estate market, or the price of the apartment, 아파트. You remember that apartment, right? This is the super duper most important index for Korean investors. Why? That's, there's no asset allocation in Korean individual investors. All you need to do, okay, the investment means, buying houses, right? Buying house. You have to have some house in the first place to get married. If you're, guy or, that is a huge pressure for unmarried guys, and right? The male versus female, gender discrimination and all these kind of things. It goes together with that gender discrimination too. Guys prepare houses, female don't prepare that, and that really seeds, okay, the discrimination in the social setting as well. The apartment or the housing price has been going up like crazy especially during the recent years over here. This is the part, right? So we are standing over here, 2026, since January or something. The government placed a huge effort to, reduce these house prices. But the funny thing is, the more the government officials place some policies, the more faster price goes up. Okay? My message to the government official: don't make any more policies. Leave the market free. Let it go free. Don't touch it. Okay? But they don't listen because they have to look busy. Okay, I guess. Good luck. I love you guys, government, or whatever. But getting back to our original question, given this social pressure about the housing, okay, what would you do? And you have social pressure. Oh, I need to get rich, and then the housing market is already high. Neighbors got rich with their own apartment. I don't have apartment. What's my alternative? Okay, stock seems to be the only solution. So they, especially younger generation or the people who don't have houses, they feel more pressure to make money quickly. And they are the ones who are investing heavily in the coin market in 2000, and then now is in the semiconductor industry stock market. Given this situation, I show you, okay, the stock price chart of Samsung Electronics and SK Hynix, those top two companies in Korea. And you see this over, ever since 2020, okay, until this year, until June, okay, 25th, okay. SK Hynix price, suddenly skyrocketed like 10 times over the past single year. Can you imagine that? All right. They were doing nothing over there. They seem to be doing nothing, but they were doing. Actually, they were fluctuating little by little over here, but it doesn't show up that much because we had such a dramatic spike this year. How about Samsung Electronics? They also increased like 5 times to 7 times or something like that over the recent 1 year. What is going on? And given that you have social pressure like this, okay, real estate market, okay, now you see this, what would you do? What will come into your mind? Okay, stocks seem to be the only solution. Your neighbor gets rich. Why don't I just join this? Regardless of being bubble or crash. Wouldn't you feel that anxiety? Okay, that's the issue. Okay, more precisely, over the recent 1 year, it looks like this, right? And you see more bumpy road going up until the end of June. And in July, if you look at it, started to tumble down like crazy. Okay. And today it just bounced back like crazy, okay? Another crazy day. So that's the situation. Now, what I want to say is 3 things to answer the first question: over extrapolation, FOMO, and learning effect. When you see a price trend, your eyeball makes you over extrapolate. Over extrapolate means like you tend to, draw some extension line, okay, based on certain curvature, so that you make a decision either ride on the momentum or be a contrarian. You are believing that the market is predictable, whereas the economists say the market is not predictable. You believe the momentum will sustain and then let's go. That's one symptom. The other symptom is like, oh, the market is going up, but there will be a crash contrarianly. So you take a contrarian position like that. In either ways, you are not believing in neoclassical economics. You're a behavioral guy. So over extrapolation, are we the only victims of this? No. Newton, here's my favorite example. South Sea bubble, 300 years ago or something, right? There was a bubble company called South Sea, in Great Britain, the stock market performance was really good, was going trending up. Isaac Newton, the scientist, right, purchased the stock when the price was rather low, and he made money, okay, and happily sold his stock at about 300 pounds, right, per share. And then guess what happened? Well, how much would you feel happy? Well, it depends on what your neighbors do. The thing is, unfortunately, his friends, okay, got even richer by selling off after the momentum was taking off even more, and then Newton got jealous about it. Okay, 그건 못 참지. This is called the fear of missing out, FOMO. Okay, and then belatedly, Newton rejoined the market at much higher price like that, and then guess what? For a certain short period of time, the bubble was going even higher. And then for a short, maybe a couple of weeks, maybe he patted on his shoulder, maybe, oh yeah, I did a good job of buying it. But unfortunately, drastically, the price plunged over the next month or so, miserably. But at this downsliding phase, Newton could not sell off the stock. Why couldn't he sell it? Isn't he rational and scientific guy? No. Doesn't matter how smart you are, okay? We are all the same individual investors. We are all monkeys together anyway. Given that your money is invested in that stock, right? Newton had to sell off his stock, suffering huge losses later on. That made him study even harder throughout his life, I guess. Anyway, life is fair in that sense. Now that's called over-extrapolation. He was over-extrapolating and suffered from this kind of crashes. And it has to do with our eyeballs, right? Our animal instinct. And recent study by Hussein Gulland and then Lim Chan, right? They do this eyeball tracking technologies in stock investment studies. Where does it come from? It comes from, jet planes, the eyeball tracking, targeting technology. And then this eyeball tracking technology, well, they put it onto the sample of the people answering the question about buying and selling the stock after looking at the random walk of prices. Randomly, the price trend will be going up or down, and then the machine automatically tracks the eyeballs. And then before placing buy orders, which part do people gaze more intensively? And they found out, over extrapolation. When they look at the when they click the buy button, they are more likely to have watched this upward trend more. And then the same thing holds true over here, but also they pay more attention to this 52 weeks high kind of former peak, right? And then they are anchored on this kind of previous high level, and then they try to sell. Or in this case, this is a sell point, if I remember correctly. But this one is buy and sell, right? And like that, they study this kind of eyeball tracking technology, and then support the hypothesis about the over extrapolation. Okay. Now, another is something called the Minsky moment. With this development of semiconductor technologies, right? Recent development in this area, memory chip industry, well, that gave us enough of a chance to believe that the new economy has arrived. What do you mean, new economy? Previously, Samsung Electronics and SK Hynix were selling this commodity DRAMs for your computers, personal computers, DDR DRAMs, right? Very simple RAMs, one layer of DRAM, that was it for your computers, right? But with the arrival of GPUs and then intensive usage of machine learning, artificial intelligence, and then deep learning, well, you need super duper high capacity of memories, right? Because you have to do a lot of more of a parallel computing for matrix sum computation beyond what you used to do with your simple computer. In this respect, for your GPU is needed, and then for that GPU, you cannot just use simple DRAM like this one-layered RAMs. Researchers came up with this innovative idea. What about stacking up the DRAM chips on single die, so much so that we can stack up we can pierce some elevators like a 12-story building or something. 12-story building of chips, and then we connect it with this elevator kind of connectors, and that's called high bandwidth memory chip, HBM. Who succeeded it initially? Well, SK Hynix. Number 2, Samsung Electronics. Number 3, Micron Technologies. So SK Hynix was, almost monopolizing this technology for a period of time. It got really, really popular, and then it's all about demand and supply in this HBM market. Given that they are monopolistic or oligopolistic power in this HBM, and then the AI, artificial intelligence, taking off like super duper, they could command the high any price they wanted to claim. Okay, so the profit margin was really high, has been really high for HBM, like operating margin being 75% or something, unimaginable. For this commodity kind of chips, sometimes you suffer negative operating margin, which is you lose money by selling those chips over here because it's commodities like rice and wheat. But this one is a specialized one, and then so much demand is going on. The servers, the Oracle or Google, you call it what? I forgot the name of that, but these AI related the companies, right? They demand so many servers in their data center, and that you need HBM. So huge demand going on, and then the profit margin is rich, and then they secure the sales until 2027 with that profit margin. That isn't that good, right? From the shareholders' perspective, that couldn't be better, right? Number 2, not just HBM, but for legacy DRAM, these two companies started to enjoy a lot better profit margin. Okay, it's double bam. Why could they command better margin for this one? This is a commodity, and then higher profit margin because they had to switch their production facilities from the legacy chips to HBM. So their capacity is limited in their fab or factories, and a significant part of it has to be allocated to producing HBM. Only limited part should be allocated to this DRAM manufacturing. But the PC demand or iPhone kind of things demand for this conventional DRAM was increasing back again. But you cannot, satisfy those demands, right? Because of this limited capacity. There, the price skyrocketed like crazy. So there was an extra kick. So how much was the price increase for this legacy chip? By the way, this is Jensen Huang. What is that? The HBM together with this GPU is shown over here. Vera Rubin. But conventional DRAM price, I show you over here, conventional DRAM price. This is not even HBM. Conventional DRAM used to be around less than 10% DDR, right? For a long time. But since last July, it was skyrocketing like crazy to $70 level. over the past couple of months, it was slightly going down for whatever reason, but nowadays it's back to peak, another peak. Okay, isn't it great? Okay, so cash flow for these companies couldn't have been better, right? So the price of the stock has to go up like crazy. Okay, 10 times. You see the historically unprecedented prices and profits even from the conventional DRAM, not to speak of the HBM. So we can understand the price movement of this SK Hynix for such a high level. Another factor contributing to this number one question, I think personally, is learning effect. Okay, learning effect. What do you mean? Samsung Electronics and SK Hynix have been the country's biggest two corporations for a long time. Though the DRAM business is very volatile and risky, okay, sometimes they lose money like huge. Sometimes they money like huge. They make money like and lose money like huge swing goes on. Hugely risky business, DRAM, the conventional DRAM. But the government will rescue if bad things happen. Okay, there's kind of a too big to fail kind of an idea going on. I think, right? I may be wrong. The government, was there any track record that the Korean government was rescuing Samsung Electronics? No. But given that this is such a huge company and in charge of so many labor forces, you cannot just let it go down. And then, relatively speaking, if anything bad happens to Samsung and then SK Hynix, what about the rest of the companies in Korea? Right? They will be even worse. So the Korean people, investors, have this kind of, stereotype kind of understanding. And Samsung is the best one, SK Hynix is also the best one, relatively speaking anyway. So why don't we just put our money into these two stocks, right? It will go there, right? The smartest guys, Beida Tsinghua kind of, if it is China, Beida Tsinghua kind of, smartest guys go to Samsung Electronics or SK Hynix anyway. Their fundamental is great. Why don't we just believe in them in the long run anyway? So putting all your money in Samsung Electronics has been a successful investment strategy, especially in the 2020 stock market boom, tech boom. Perceived risk, I think, was not that high for individual investors, right? Right. And thank you. 예, 감사합니다. 한글로 이제 말씀해 주셔서 감사하고요. And number two question, right? Please understand this is answering the foreign journalist from my perspective. I will say it in Korean words tomorrow. Anyway, why did many investors continue buying as stock prices fell rather than reducing their position? Okay. This has to do with disposition effect or loss aversion. 묻고 떠블루가 곽철용. If you have watched this Korean movie, 타짜, okay, there's a famous shot about it. When you're losing any gamble, you are more likely to double down on it. Why? Loss cut selling is painful. Okay, this is prospect theory value function. This is zero gain, plus gain, minus gain, which is when you're making money, when you're losing money, and then when you are making money, you start to become more risk averse so that you want to cash out first. But when you lose money in your stock investment, you don't want to realize your loss into cash because there is a chance that the stock price will recover. Okay, why don't we just gamble it? Okay, and that kind of gambler's mind, okay, shows up in the loss situation. This is what we call disposition effect. And then this is Nobel Prize winning idea. And then who knows if the price would bounce up back higher and double down and then buy the dip. That's the sentiment going on. And it reduces your average purchase price of that security. We in Korean terminology we say it 물타기. You dilute your position somehow, the purchase price. And that is kind of mental accounting, and it relieves you only psychologically. Okay, let's say you purchased one stock at 1,000 per share, one share, and then the price plunged into from 1,000 to, let's say, 400, minus 60%, 400. Okay, what would you do? If you double down on it, purchase one more share for 400, your total purchase price will be 1,400, and divide that by 2, 700 will be your average purchase price. So by purchasing more when you're losing money, you are reducing the average purchase price. So 700 is your average purchase price. Currently the price is 400. So it seems like you are losing like 300 out of 700, 3 out of 7, about 35, 40-ish percent loss instead of 60% loss, right? Isn't it good? Better? That's why so many people try to double down on it, reducing the average purchase price. But here is my message. That only concentrates your eggs in one basket. Okay, remember, that goes against the principle of diversification. Don't double down. Okay, that's my message. But people cannot get away from this kind of ideas. And then the third question, very interesting question: how can buying the dip with borrowed money turn into margin calls and forced selling? And there came today, exactly today, very relevant case just got disclosed. And there comes somebody called Leopold Aschenbrenner. Okay, Leopold Aschenbrenner. He's a German guy, they say, and a Columbia graduate, supposedly genius guy, math genius, and in economics, an undergraduate in Ivy League. And then he was making us, track record in Jane Street, was it? Or together with FTX guy. By the FTX guy, was it Sam Bankman-Fried? He belonged to that group. And then also after that, he joined OpenAI and made his name somehow, working with Ilya Sutskever or something. And then eventually he got fired for whatever reason they may argue. They may say, company will say, you disclosed information illegally, and then whereas this guy was like defending himself. But after getting fired from OpenAI, he wrote a report. I think he has a very wonderful writing skills as well as analytical skills, so that he was very convincing about the future of AI, and then he was arguing about there will be huge demand increase for power generation going forward. That was like 3 years ago he was doing it. With that report, he made his name and then became a podcaster or YouTuber, kind of social influencers. And then together with that, he was able to attract a lot of money, tons of money from Silicon Valley. How much? About $45 billion, right? He created a hedge fund and then leveraged up so that total asset under management turned out to be $45 billion. And the thing is, he took a leveraged position upon SK Hynix and this, welcome to semiconductor world, baby. What is it? Nebius, SanDisk, Bloom, and then Micron and TSMC recently, South Korean companies, right? And you see this Squid Game, he was joining it, right? We believe that he is a super rich guy and a super genius, 24-year kid, whiz kid, and then, but all of a sudden his position got attacked by bigger funds like Citadel or big funds, hedge funds. Why? Because his position had to be disclosed, right? But he was, I guess, I don't know, did not manage the risk enough. Okay, his fund was called what? Situational awareness or something. Okay, situational awareness. But I think he was unaware of the risk that he was taking. Maybe he was unaware that he was overconfident. Maybe Columbia Business School, they teach a great behavioral finance, but once you become overconfident, it doesn't matter how much you learned or not. It doesn't matter whether you're a genius or not. I showed you with Newton's example, right? Doesn't matter if you are a genius or not. You will over extrapolate and you will jump on the bubble. So eventually things happened, okay? So much so that what? This guy, okay, his position, they had to do fire sale, okay? And then now he's, $0. Why are you here? I thought you were financially stable. Welcome to the party, man. And then start with 4 times leverage, just like, Leopold, right? Here's an example. Let's say you do 4 times leverage as a hedge fund and they invest in semiconductor industry. So just to give you a numerical example, through 250 your money plus 750 borrowed money from what we call prime brokers, right? As long as you are a hedge fund. Together, it will be 1,000. You invested in a stock today and its price just jumped by 25%, let's say. Then what? Your whole asset under management goes up to 1,250. Wow, after repaying your debt 750, you will be left with 500. And remember, your initial equity investment was only 250. That means you gained 100% return. Wow, isn't it great? 4 times leverage, right? Power up. But the thing is, what if the market goes to the other side, okay? If the price plunged by 25%, then what happens? Your asset under management will be 750. After repaying 750, you will be left with only $0. Oh my God, your equity position is completely wiped off. Minus 100% return. 4 times the power, this time to the negative side. That's the danger of this leverage. Don't take leverage, okay? I tell my students time and time again. But one of my IMBA students confessed. My student said, Professor, you know what? Every time you say don't take leverage, I feel like devil whispering to me, take the leverage. Your precious money, take the leverage. Don't, okay? At that moment, what would the prime broker do to you? They will call you, ring, 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 and then they say, but can you afford to keep your position? Pledge more money, okay? Which is called a margin call. Otherwise, the prime broker or the lender will sell your stock by force, okay? Forced selling will happen. We call it fire sale, okay? Remember, $45 billion. No kidding, man, okay? Thinking about the demand and supply in microstructure in daily market for single stock like SanDisk, SK Hynix, right? That huge amount getting pumped into the market will definitely plunge down the market like price like crazy. And that will create a downward spiral because you are not alone. The thing is, this hedge fund, okay, situational awareness or something, is not the only hedge fund that took up this crazy leverage. It's like a one tip of the iceberg, I guess. There could be a lot of different hedge funds who took similar position, leverage, and that will create downward spiral. That's what we are, afraid of. And that was what we were suffering over the past couple of weeks. And think about the volatility of SK Hynix, right? SK Hynix annualized volatility of stock return was 82%. 82%. I told you, okay? The example over here was about 25% minus because this guy's position was 4 times leverage. Imagine 80%, one whole year, okay? What kind of disaster it could be, okay? That's this part. Histogram of Korean stock market volatility, okay? 90% or up to 90%. So that's SK Hynix. Very risky stock. Memory chip stock, very risky. Now, moreover, SK Hynix did an ADR IPO, which means nowadays, ever since July 10th, US investors can purchase SK Hynix's ADR, American Depository Receipt, in NASDAQ. You don't need to come to Korean market and buy SK Hynix, buy and sell, but just directly buy from NASDAQ over there, okay? And then they raised capital. This is the chairman, Che, July 10th. And then the funny thing is, SK Hynix's ADR, annualized volatility, guess how much? It was 187 percentage point until now. Way higher compared to the general histogram of South Korean stock market guys, right? So imagine that you are situational unawareness. You're in trouble, man. And then with that, right? During the July, what happened to the stock price? Cumulative return of SK Hynix and Samsung Electronics looks like this. This is 0, and they were losing money like crazy cumulatively. Okay, up and down and up and down. There were some crazy jump up, but typically it was trending down like crazy. Okay, a single day more than 10% down, and then up and down, down, up, down, down, up. We say it right. And that it turned out to be cumulatively 60%. Now, guess what must have happened to this guy? This period, fire sale, man, fire sale. He could not endure more than 25% lost, right? So he had to do fire sale. Who would buy this one? Well, Citadel was taken over with the block trading, okay? Very interesting deal was going on. And then today, after making whole of these slides, and today the price jumped by like 30%. Price limit hit for this huge stock. Very interesting phenomena really happened. Really, really spiky. Why going up? Because the situation was complete. Okay, for this guy's okay, as long as this guy is concerned, we can, we are safe from this kind of trouble, But going forward from now on, we still have some concerns because he's not the only one leveraged up. And then the fourth question: how do fear, herd behavior, and loss aversion make a market sell-off more severe? Well, before I start to answer this question, let me start with more basic question before going back to the former period before the peak. Because to answer this part, you need to understand what was going on over this period in your psychology. When the market booms and the bubble increases, then overconfidence builds up in you. Why? You are more lucky, and then this is an easy period for everybody to make money. If the market gets into a huge bubble, everybody makes money anyway. And by the way, this guy, okay, the report said that this guy was making huge amount of money, like 400% over the past 2 years or something. No wonder, man, come on. That was really trending upward anyway. Was it because he was genius or because he was lucky? My bet is that he was lucky. I know, I love Columbia guys. I love these, super math genius guys. Respect you, but over this period, anybody can make money. I also make money. Okay, everybody. And the thing is, you get overconfident during the boom time thanks to your success. Why? Because there's a self-attribution bias. I succeeded because I am smart, not because I am lucky. That's human nature. That's my first paper in my academic career, right? And then you say, oh, I found the Warren Buffett in me. Yeah. And then there, I believe in AI vision by Jensen Huang and whatever superstar CEOs you will dream about. And then that's the overconfidence that you build up, okay? And then, you get more stubborn and social transmission bias takes place from then on. Let's go when the downside happens. The thing is, social transmission bias is a huge one as well, okay? And then this is proposed by Professor David Schleifer of University of Southern California. And the question is, do you invest alone when you're doing stock investment? Okay? Do you download public disclosure and read newspaper articles very carefully and then independently decide whether to buy or sell without talking to anybody? Just decide yourself in silence? Or do you talk to your neighbors and friends and families and then confirm your ideas and get some discussions and then finally invest, okay? And he says investment is a social behavior, okay? In a party time, in a small chat, okay, small talk, you sometimes talk about the stock investment and how you made money and brag about it. Do you invest based on the discussions about stocks and coins and friends, like that? We usually invest together, okay, and then additional social psychology concept is needed. And there in the small talk setting, there is a transmission bias. Only success story gets transmitted. The thing is, you don't talk about bad results, right? Almost nobody says I lost money because you look stupid, okay? You want to look smarter. So that's why you will try to talk something good about your success story. So that's why there is a transmission bias. And then the people who listen to those success stories get jealous about it disproportionately more and then get more anxious to buy that very stock. Oh, my friend got rich, only rich. He doesn't tell about your failure story. Don't get jealous, but you get jealous, right? And you jump into the market. And that kind of frenzy is like a pandemic. And there is an immunization process over time. Time goes on. Think about what happened in the pandemic, okay? COVID-19. Initially, nobody is immune to any frenzy. Nobody is immune. You are susceptible people, 100%, right? Not immune, but eventually some small number of people start to get infected. And some people get the Tesla frenzy or AI frenzy. And then they buy the stock. And then with that, demand increases, price increases, and then you make money early stage, like Newton did, right? And then you get into the fever, okay? And then eventually, there comes a time to learn about the truth and reality. Oh, Tesla is not that sexy company. And then you get burned somehow. And then you get out of that stock, okay? And then that's when you get over this disease and then get immune to such pandemic, okay? Some people will get sick and tired of AI boom stories, and then they will not look at the AI stock anymore. That's the immunization process, right? So as more people get immunized, the bubble will start to go down, and then crash will happen, and then crash will intensify, and then it will take time. The crash does not happen instantaneously, boom, and then go down. No, it takes longer period of time. And there, another interesting factor is that some people get reinfected. Reinfected, what do you mean? Well, if you remember the COVID-19, there were many people who got infected more than once, okay? Even though you feel like you got immunized, after a certain period, you get infected one more time, two more times. Some smaller number of people will get reinfected. And that means, in terms of stock bubble, the bubble will take off one more time, two more times, three more times. It will not be like just taking off once and then crashing once and period. No, it will revive, resurrection of the bubble in a small scale. And there, very interesting phenomena will add to this, which is called echo chamber effect. Echo chamber effect, I don't know how you read it in Chinese. 金黑, 智黑, I don't know. 금묵자흑 근주자적 in Korean pronunciation. And if you look at your social media behavior, look at the channels that you subscribe to, okay? Left-wing guys subscribe to left-wing social media. Right-wing guys subscribe to right-wing media. Trump, MAGA, they will subscribe to their own media. They will not even look at the left-wing part of it, and vice versa. And that mutually, they will reinforce themselves. MAGA people will get together. To them, everybody in the whole world must be MAGA in their mind. Okay, that kind of thing, clustering, is called echo chamber, social psychology, right? And there's a confirmation bias that drives this kind of behavior. Same thing holds for stock bubble. You get into Tesla frenzy. Oh, you subscribe to the strong believers of Tesla. Elon Musk, sexy brother. And then they will subscribe to this Elon Musk, great story. AI frenzy, AI brother. They will just subscribe to each and then say, you are the number one, and then mutually reinforcing this idea. And they'll keep on buying. To them, every kind of plunging of AI stock price will be looking like a chance to buy the dip, okay? And then the bulls will get together and then perceive it in their own way. Whereas the bears will get together and then they will create their own narratives where every price going up to these bears, they will say, oh, this is a chance to short sell and make money, okay? That kind of thing. 근불자 buy, 근배자 sell, right? Their social behavior. The thing is, Engelberg and then Cookson and Mullins, they found out that this kind of traders who suffer from echo chamber effect, they underperform. The thing is, they are not just individual investors like you and me, but fund managers and the professional investors, they also suffer from this kind of echo chamber effect. And that creates complicated bubble, more complicated bubble like this. So social transmission bias, contagion effect is huge. Selective information transmission, where success stories are told while failures are hidden. Only the positive aspect of the certain stocks are highlighted and communicated. Words without substance travel far and wide, maximizing the dream of a jackpot. Yeah, like that. And then the process of mutual conversation reinforces trust. And then, oh, you also say Tesla is great or SpaceX is great. I also say SpaceX is great, so SpaceX is great. That's echo chamber effect, but we don't realize it, okay? Because we are living in a small world anyway. And then the bubble grows exponentially, and then periodically, earnings reports are released, and then it leads to corrections. Those earnings release could be own company's earnings release, for example, SpaceX's earnings release or SK Hynix own earnings release may give some time for us to realize, oh, we were dreaming too high. Let's get back to reality. Not only that, but also the earnings release or news about any companies in this supply chain. For example, this time Apple was big. Okay, Apple. They did some earnings announcement, and then the CEO complained. Okay, CEO complained. What? You know, those chips, DRAM manufacturers, they are charging too high prices. So that hurts our margin. Our poor Apple, you love this Apple iPhones, don't you think this have to have some better cash flow than this? Those chip manufacturers, they are charging too high prices. And that was spooking up. Oh my God. And then people, used it as a trigger to, sell off semiconductor stocks. Periodically, this kind of things, right? People get so much afraid of whatever. It could be cash flow related or news, right? Seemingly related news, right? That will trigger some corrections periodically. Even so, strong believers will buy the dip, and repeatedly the stock converges to intrinsic value slowly. And the pattern proposed by Professor David Schleifer looks like this. Minsky moment kind of smooth bubble and crash curve is here, even smoother than that, taking longer time. But more important is the spikiness in the smaller, shorter period of time. He called it Stegosaurus stock price model. Isn't it cute? Stegosaurus model. Like, not a hedgehog? I don't know. But he said it. And Stegosaurus, what is that? Yeah, I know many of you love Tyrannosaurus or Allosaurus, but there was a vegetarian dinosaur called the stegosaur like this. Doesn't it look like this spiky thing pattern? The thing is, the spike is much more random than this, by the way, okay, like this. And then, to me, if I apply this kind of idea to SK Hynix this year, I'd say it was Stegosaurus breaking down, okay? Like hip hop or head spin or windmill or doing pop-ins, right? Like that. And that, is creating random spikiness like crazy. Up, down, up, down. I don't know what the hell is going to happen in tomorrow, right? So that has been what we've been experiencing. And social transmission bias. You only see and talk about what you want to see and talk about. The echo chamber effect is huge. Why? Because social media environment is so much fragmented. And then birds of a feather flock together. Believers versus non-believers of AI. They fight like crazy. And then bounces back. Bakom, we say. And then that creates another fear of missing out, FOMO. And then that creates a smaller scale bubble and crash. And then that goes crazy like that. For a prolonged period of time, we suffer that. Lastly, could this sell-off be the beginning of a broader financial crisis? Very interesting and important question. My short answer is not really. Typically, a country's financial crisis like the one Korea suffered 30 years ago comes from a failure to repay foreign currency debt by the government or depletion of foreign currency reserves. Okay, so government debt, especially foreign currency ones, that would be creating twin crises like crazy. Of course, domestic debt crisis or a little bit of panic would be there, but compared to what we had in 1997, no, I believe we're stronger than that these days. Korea's foreign reserve is around $420 billion, which is about 20 times bigger than what we used to have in 1997. And then foreign reserve graph or time series since 1996 looks like this. At this crisis period, it used to be 3% of GDP. Nowadays, it's like 23% of GDP. So the Korea has grown up, and then we learned so much about in this period. That was so much painful indeed. So we are better prepared. Another point I want to make is that the central banker of Korea, 신현송 교수님, 신현송, he is a super duper great economist and well respected in academia as well as in practitioner wise. So he's a very smart guy. He knows how to operate this situation. And you see that recently we were running down with the foreign reserve, but gradually and pretty soon we reversed back to the original level, near the original level of this foreign reserve. So he's managing very well, I believe. Right now, the Korean government debt to GDP ratio is around 50% level. More precise number you can get some from World Bank data. Quite manageable level compared to the 150% level of Japan or 90% level of European countries. The tax income of Korean government is anticipated to improve thanks to the booming of the memory chip businesses. Okay, remember the funny thing about this stock market crash and craziness is that the fundamental cash flow is hugely positive. Couldn't be better. Okay, thoughts we are living in a new economy, right? So fundamental cash flow is very strong. The thing is, what should be new equilibrium price? Were we shooting too high for it or not? But it's not like our fundamental tanking down like crazy. No, it's not that situation. One concern maybe, what if the government spends too much on social security policies and run budget deficit too much? Given the orientation of the current administration, it depends on the left wing versus right wing kind of argument. Another concern could be, what if the interest rate increases because of the heightening of inflation rates coming from the geopolitical risk, US, Iran, Israel war, and then the oil price going up? Okay, holy cow. We don't want that, right? We don't want that because of household debt, okay, to GDP rate is kind of high, okay, not kind of high, very high. So we don't want that to happen, okay. So that is kind of the situation I would say. What about the bankruptcy rate in the data compared to previous financial crisis? Right now, yeah, it's higher than 10 years ago. Bankruptcy rate, corporate bankruptcy rate, small, mid-sized companies as well as big companies, right? It's higher than before, but not like this, okay? So that's one thing I wanted to highlight, okay? There is a concern, but we have competent central bankers and then the central banking group. They are, super duper guys, I think. So that's something we, rest on, I guess. So that's the thing I wanted to highlight. Anyway, 谢谢. Thank you very much for listening to my discussion. And then any comments, please, I welcome. And then tell me if you have any long questions. You can email me. In the description section, you will see my email address, or you can question me, ask me questions in this discussions windows. Thank you. And then high risk, high return. Yes, you are right. Yes, how can we manage the risk is always a question. And then the high leverage, right? Longer period of risk. Yeah, one thing I wanted to say is that you take leveraged position, it automatically drives you to be more anxious because of the concern that you have to pay the interest no matter what, and you have the obligation to the creditors. So that will narrow down your scope. shorter horizon. The thing is, if your leveraged investment makes money quickly, then you are lucky because you will become risk averse and you want to cash out your gains as soon as possible. Short run gain with leverage, that's a lucky situation. The bad thing is when you lose money with the leveraged position. The disposition effect predicts what? You will be seeking more risk. You will hate cashing out your losses when you lose money in your stock investment. But you forget about the leverage position that you had to repay the debt, and that animal spirit drives you crazy and say what? Oh, I don't want to, realize my loss. I have to repay the debt, and what if there is a chance that we can hit the jackpot tomorrow, and that will always drag you to keep that leveraged position and money losing leveraged position for a longer period of time. 강제 존버. And that will drag you down even further. So that creates a huge trouble in the long run. So leverage, don't take it, please. No, as an individual investor, we cannot afford to take that level. So many people, their whole lives got screwed up, so don't go there. That's my message. Okay, thanks for listening. Okay, thank you. Bye-bye.